All right, joining me is Chen Arad, co-founder of Solidus Labs, who's a unique company. They have built state-of-the-art trade surveillance and risk monitoring tools specifically for the digital asset space. So I would say in a nutshell, they work with crypto exchanges, trading platforms, financial institutions, even regulators to help detect and prevent financial crimes and market manipulation within the crypto sphere. And I came across this firm a while back, and I just found what they were doing to be extremely interesting because this touches a lot of different aspects of crypto. And I should note, Solidus is also involved in TradFi as well, but we'll primarily be focusing on crypto here today. So, Chen, thank you for joining me.
Absolute pleasure to be here. Thanks for having me.
Okay, so I just gave that very brief description of Solidus, but I'd love to start by having you explain in a little more detail exactly what your firm does and some of the problems you're solving. How do you like to describe this just at a high level?
Absolutely. So Solidus is a trade surveillance solution that at this point that is born in crypto. In crypto's incredibly fragmented, less regulated, 24/7, more complex markets, and that is where we do a lot of our work. But we've increasingly brought efficiencies from the way we had to develop it for this more complex market into other asset classes, or TradFi, as you call them. Citigroup named us about 3, 4 years ago category definer for crypto trade surveillance. We are also increasingly an agentic compliance focused company. So, uh, you know, having to do the work we set out to do in crypto, which is to focus on detecting and understanding and preventing market manipulation, price and volume concern. It's important to say for folks who might not be that deep in the financial compliance space, trade surveillance generally refers specifically to the risk monitoring solutions that look for price and volume manipulation. So when someone tries to inflate the price by doing various kinds of manipulative schemes like wash trading, which is trading just for the sake of increasing volume with no economic benefit, pump and dumps, which is when you, in one way or another, create false momentum around an asset, so the price goes, and then you dump it by throwing. There are a lot of different ones, but Solidus is a trade surveillance solution that was very focused on preventing these sort of issues. Um, we are our roots are at Goldman Sachs in big bank engineering. That's where my co-founders come from. I was very clear in 2017 as Wall Street started looking at digital assets that the challenge of understanding risk, understanding price manipulation is going to be very different because the assets are decentralized, because they're traded 24/7, because there's so much more the markets where retail and institutions operate together. So, to address that challenge, we had to build our system quite differently than the way it's built in traditional finance. Um, Historically, trade surveillance solutions for designed for assets like securities or derivatives only look at trading data, so essentially at the order book and the market data. We found out very quickly that they don't, even in traditional finance, they don't operate quite as effectively as their users would want. But in crypto specifically, to properly understand when someone is trying to manipulate the market, you have to look at multiple markets at the same time. You have to look at transaction data on chain and off chain simultaneously, cross on and off chain, as we said. You also, very important, need to give a much harder look to things like sentiment and social data, what people are saying on Reddit, on Telegram, and other sort of real time events. And ultimately, we built a system that absorbs all of these different kinds of data signals in one place, and then utilizes rule-based logic and increasingly AI, and increasingly more than just AI agents, so autonomous AI models that work with compliance teams in order to detect anomalies, understand when someone is trying to, manipulate or scam folks out of their money. I'd also say that we obviously, a lot of us who are involved in digital assets see it as something that's transforming traditional financial services, and that is very much true. I think in some ways, traditional financial services are also increasingly transforming crypto. We're seeing this merge happening in both directions with tokenizations, ETFs, which I know we'll talk about. But digital assets are also a really important opportunity to transform how we monitor for risk and how we do compliance in traditional finance. Um, I'll finish with a couple of sentences because I feel like I've been talking for a very long time and I want to make sure you actually get to ask questions, Nate. But it's actually, there's an untold, unspoken story to compliance in traditional finance. And the truth is that it's actually not very effective. There are immense resources and immense regulatory efforts dedicated to trying to prevent things like insider trading, like fraud and scams. The reality is they still happen a lot before we even go into crypto. And crypto has its own market integrity and market manipulation risks, but they still happen a lot. Most money laundering professionals tell me that only 3% of dollars laundered are ever identified. There's something called SAR, Suspicious Activity Report, which compliance teams have to file, to regulators. The data shows that only 4% of these reports are actually get looked at, which means that 96% of compliance work might not be focused on the right stuff. When you look at things like insider trading, there's a recent study by the University of Technology Sydney that it still happens in 20% of M&As in U.S. stock markets. So I guess what I'm trying to say is just to bring it all together by saying we started by focusing on crypto. Crypto is in many ways a roadmap for what markets are going to look like: more fragmented, more permissionless and open. We see that already in traditional finance, but we've always done it knowing that these issues are not effectively solved in traditional finance, and that crypto is not just an opportunity to create new and interesting financial products, it's also an opportunity to create safer markets using the transparency of the blockchain and just new modern approaches. AI is playing an important role in that, more than just a buzzword. So that's what we're about, and we're really excited to see all of that increasingly bringing efficiencies also to securities and derivatives in a lot of work we've been doing recently.
Okay, so that was an absolutely fantastic overview. And yes, I have several follow-up questions that I want to ask you based on what you laid out there. But before we get to that, just to be clear with Solidus, you mentioned working with compliance teams. And for people listening to this, I just want to make sure they understand who would be typical clients of your firm. And you don't have to name specific names. I noted some general groups at the top of the podcast, but just explain that a little bit more, who you work with.
Yeah. So again, the capability we specialize in is detecting market manipulation and other forms of abuse. The way it's used is oftentimes in order to comply with regulation. So, to your question, who our clients are, then essentially any firm or service provider that is involved in digital asset trading and is exposed to the risks related to it. Regulators, as we all know, regulation has increasingly been catching up with crypto, and today, almost anywhere, the U.S. is sort of the last piece where, federally, there's now a lot of effort to create requirements. But almost everywhere, if you're offering a crypto service as a centralized platform, like a Coinbase or a Binance, you are required to comply with various requirements, including to monitor for and prevent market manipulation on your platform, including, for example, to monitor for anti-money laundering. So almost any financial institution will have a few different teams that's dedicated to doing that. And we work with those teams. In terms of the kind of firms, then, as you can imagine, a lot of crypto exchanges, some, just to name a few, that we're very proud to be partnered with, BitMEX, Bullish, eToro, and others. We work with a lot of brokerages, prime brokerages, FalconX, etc. We also work with traditional financial institutions that offer crypto services and ones that don't on securities and derivatives. And we also work directly with regulators and law enforcement in certain cases. In those cases, we help them investigate or monitor if there's anything they should investigate. Finally, there's also a whole new world in crypto or DeFi or just the decentralized finance realm of various kinds of entities. So we do also work directly with decentralized protocols, decentralized exchanges, and essentially, like, let's call it like a new and kind of more unique kinds of entities that offer access to trading. There's obviously a bit of a debate on whether they're, how are they as responsible as a traditional financial institutions? Are they not? That's a lot of what's being discussed on market structure right now on Capitol Hill and other places. But that's a broad overview of who the companies we work with are and how we help them.
Okay, so can you walk through a few basic examples of market manipulation or trading schemes and how Solidus is flagging those? I know there's a lot there, but maybe you can just give us a few more straightforward examples.
Absolutely. So let's start with a term that I think most people know. It's definitely highly illegal and highly enforced against in almost anywhere around the world, the idea of insider trading. That's a form of market abuse. Um, that again is something that people go to jail for. Essentially, what it refers to is an a big part of how regulators see their roles, and historically also a big part of capital markets being successful is about having equal access to information. Now, obviously, trading oftentimes is about thinking about things that other people didn't think about, but there are also ways in which it's illegal to use information that you might have in order to trade ahead of an event. Like, a classic instance is I mentioned M&As earlier. If you work for a traded company and you know that there's an acquisition happening that might increase the value of the stock, then usually you're legally forbidden from sharing that information or trading on it. It's part of However, it does happen. You might not do the trading. Maybe you'll contact someone who will do it on your behalf, etc. But that's again still in the context of traditional markets, where there's the access is relatively constricted. Now let's think about how something like that can happen in digital assets. We we published an extensive research on insider trading that we refer to as decentralized exchange to centralized exchange. Crypto assets always exist in on decentralized blockchains before they are listed on a centralized exchange. And then the ones who do well, Bitcoin, Ethereum, and much broader list, ended up being listed on a centralized exchange. Now, we looked at three of the world's largest leading exchanges, at over 200 listings that happened in the span of 18 months, and we essentially what our tool does, and it's something we developed together with regulators because they monitor for it. It looks at all the trading activity on dexes. We cover more than 98% of that trading volume, and then we correlate it with news events like, for example, a listing. We found that in 56% of cases where a DEX available token, a DeFi available token, is listed on a centralized exchange, there's trading right before it that strongly indicate insider knowledge. So it would usually look like someone is buying, a couple of weeks before something happens, and then selling immediately after the news happens, which indicates there's some sort of insider knowledge. So that's one example. Wash trading. No, it's an interesting example because you can see how the context of a decentralized market and a decentralized asset further complicates the ability to monitor for it, because it's not a constricted list of people. And anyone can create a wallet if you have information, and kind of try to create a few degrees of separation. And it's harder to catch, and you have to look at both on-chain activity, the trading on the DEX, and off-chain activity. Another classic, a very common term when it comes to market manipulation is a pump and dump, which I mentioned earlier. At the end of the day, it's speculation followed by a very timely sale. Let's call it that way. Essentially, you'd see that a lot, for example, in the meme token ecosystem. We just published actually research last week actually, specifically on the scamosphere across meme tokens on Solana. So essentially, we looked, we found that in 98.6% of tokens listed on a Solana-based platform called Pump.fun, which is one of the kind of like the biggest, the highest volume platforms on Solana, 98.6% of them don't keep their value after 6 months. But if you look at the data, and I highly recommend anyone who's investing in meme tokens, specifically on Solana, would take a look at our research. It's available for free. In many cases, it happens within hours. So when you have a market where almost all of the tokens that are listed on it get pumped, kind of there's buzz around them on social media. They get you see them on Reddit, etc. But within hours lose their value, go back to under $1,000 in total liquidity. It's just clear that there's a very small group that's making money off of it, and it seems predatory. So again, those things do happen in traditional finance, but obviously there are kind of new ways to do them in crypto that we're very focused on. I'll stick to these two examples, just again for the sake of time.
I'd love to ask you more about the social media element here and how that plays into it and how you monitor around that. Because to your point, I do think of Pump.Fun, where someone launches a meme coin and then you see them promoting it out on Twitter or X. I'm out there. I see this fairly regularly, and perhaps you have some other insiders involved with whoever's doing the main hyping out on social media. I know this is a little bit of a cliche example, but it's one that I think people in crypto can certainly understand. And so, how does social media play into your surveillance?
I mean, anything, any form of market manipulation or fraud or scam that is related to speculation these days is almost always related to social media because it's so easy. You post about it. People see that whether you're credible or not. Like you post about it in a lot of places. You create some buzz around an asset, and then you find the right way to sell all of a sudden. So social media is a huge part of that in digital assets. It's also, by the way, increasingly a huge part of understanding the health of trading, the integrity of trading in traditional finance. I think the GameStop affair a couple of years ago, which is still ongoing, like we still see the ripple effects of that, was a really great example of that. Crypto, as I mentioned, is a bit of a in some ways it's a roadmap for what traditional finance is going to increasingly look like, especially this point about direct access for retail to trade independently, off-platform trading, and those and it means that there's more and more volume and liquidity that is more influenced by speculation because again retail have less resources than institutional, and they're often basing their decisions in trading on social media. So it's simply, in my view, and in our experience, impossible to properly understand whether a kind of whether a bout of trading that looks suspicious is actually malicious without also correlating it with stuff that's happening on social media. Another important element of it is that historically, trade surveillance in traditional finance is very retroactive. So, you close the day at 5 p.m. or whenever it happens, you take all that data, you load it into a trade surveillance system, and on a T+1 level, you need to kind of report if anything happened. Obviously, the problem with that is that even if you detect something, you detect it late. When you look, looking at social media is also a very important part of the ability to detect proactively, preemptively, or at least in real time. Because if you're monitoring a lot of social media, Reddit, Telegram channels, etc., you can pick up that there's buzz around, let's say, a specific kind of asset that doesn't correlate with trading volume, and it doesn't necessarily mean that someone is doing something wrong, but it gives reason to scrutinize the trading of that particular asset in certain cases more often. So it's absolutely necessary in digital assets specifically, but across capital markets.
And technically speaking, and we don't have to get too far into the weeds here, say with social media, how are you actually monitoring that? What goes into that? What are some of the tools being used?
So there's a combination of technical capabilities and proprietary ones that we've built over time. From from web page scraping to other sorts of data signals. Obviously, some social media is more challenging to monitor than others. Like obviously Telegram is a different story compared to Reddit or things that are completely Reddit ultimately is mostly open. There are different tools, and we also have a lot of great partners that are focused on this. But ultimately, a big part of the secret sauce of our work is how to do that very quickly and know how to pull the right data in the right place. That's also, by the way, where AI can play a very important role, because if you can monitor a lot of different things, but if you don't have the ability to actually scan through them and correlate them with other pieces of data very, very quickly, then having all that data sometimes doesn't matter. So it's a combination of the ability to absorb and find the data, absorb it, and then of course also process it in a timely manner.
I'm glad you mentioned artificial intelligence because I saw last week that Solidus launched agentic-based compliance where you're leveraging, as I understand it, this network of AI agents to
Yeah.
improve trade surveillance. Do you want to talk about that at a high level?
Oh, of course, I'd be happy to. Few things would make me happier, as they say, because we really see it as something really, really exciting that is not just incrementally like 10, 20% adds efficiency to the work of compliance teams. It can 100x over time the ability to do compliance effectively. So first of all, just the evolution of AI, right, started with machine learning and algorithms that reinforce themselves, etc. Continued, of course, a few years ago to the enormous revolution of generative AI, which essentially is our models that understand to a large degree intent, and they can, with some autonomy, like look across a lot of different kinds of data and do one task at a time. AI agents is all the buzz right now in the AI world as the next iteration. And by the way, there are also 4 iterations after that. If anyone wants to listen to Sam Altman talking about that, it's super interesting and sometimes scary. But AI agents essentially are the next step of generative AI. They are models that are more autonomous, and you can actually give them a mandate to do more complex and long-term tasks. So instead of just telling them, can you please write this report to me, you can tell them, look at all this, please monitor all these different kinds of data, and let me know when you understand something is problematic. So they almost work like supervised employees under a compliance professional. And there's a fleet of them, or as they like to call it in AI jargon, a swarm is the term they use. That looks at different things. So one of them can be focused on pulling the right kind of data, another is focused on, for example, resolving false positives. One of like trade surveillance analysts spend up to 60% of their time daily just looking at alerts and saying that this alert doesn't matter. Just to explain to you like how absurd the situation sometimes is. These are people who signed up to fighting crime and protecting consumers, and they find themselves spending a lot of their time just responding to false alerts shot by technology that is not precise enough. So that's something that a lot of our clients are utilizing AI agents for, because they can observe the person resolving and then over time become very, very good at making sure that only the most important alerts or concerns are actually raised, and that allows a compliance professional to focus on actually investigating those rather than spend so much time at saying what doesn't matter. There are a lot of other ways in which they're used. Again, pulling data from a few different sources, let's say trading data and transaction data, on-chain, off-chain data. But all together, they essentially act as a fleet supervised by a human. No legal decisions should be made by, an AI model, but it allows the human to spend time on what they actually signed up for and what they do best, which is evaluate very nuanced things and kind of bring in experience and bring in calculations and a human authority. But the main thing about agentic based compliance is that it allows to just streamline in a very effective way a lot of work that is taking a large part of the day of compliance analysts and allow them to focus on what matters most. When you think, now obviously this is something that's already solving issues and is of a lot of interest even in TradFi. But if you think about where digital assets and crypto is taking us, a world where there's so much more permissionless activity, there's so much more financial activity that happens on a blockchain. So all of that data is public and available, unlike in traditional finance where most of the data is black boxes and you can buy it, but it's very expensive. It starts raising questions like who's going to monitor all of this data, right? Who's going, are humans even, when you suddenly have, instead of, for each reportable event in traditional finance, you have 1,000 that are now reportable and monitorable because they're on a blockchain. You need to start bringing in AI to be able to effectively use that transparency. The transparency of the blockchain is great, but it also creates so much more data that without having solutions that can make sense of it and focus the humans on the most important parts, then it's not relevant. So we've already been seeing incredible efficiencies, but it also was important for me to emphasize that this is a really important move towards the direction in which digital assets are taking us more broadly with tokenized assets, etc.
Yeah, it's just amazing to me how quickly the entire artificial intelligence space and movement is evolving. And I thought you made an excellent point there, just the intersection with crypto. You can clearly see the direction of travel here. I want to switch gears on you. Prior to us recording, I was telling you a little bit about my background. I'm an ETF industry uh, guy. I've been in the space for a long time, and so I have to at least get one ETF related question into you. And I think the way I'll frame this is that market surveillance in general wasn't something that I paid a whole lot of attention to until the spot Bitcoin ETF application started getting some traction from the SEC several years ago. And as I'm sure you're aware, this entire topic of surveillance sharing agreements with a regulated market of significant size came up. And, there's a lot of discussion here. But I mention that because we now have spot crypto ETF filings covering digital assets such as Solana and XRP, Dogecoin. I would love to have you talk about surveillance for some of these other assets and maybe what you think regulators are looking for here. Because with spot Bitcoin and spot Ether ETFs, ultimately regulators relied on the CME futures market is the venue to be surveilled. But that's not going to be the case moving forward, in my opinion. There's nothing that says you have to have a regulated futures market in order to have a spot ETF trading. So I'm just curious your thoughts around this entire topic.
Well, first of all, just say, and we talked about this before, right before we started recording, that you found a good sparring partner because, one of the first times I've become very interested in ETFs. So it's kind of like the mirror image of your case, right? One of the first times I've become really interested in ETFs was when we saw that the SEC is not approving them because of the, and I quote, lack of sufficient surveillance and shared surveillance agreements. So we almost kind of came to it from opposite directions. But in some ways, the the rejections of ETF applications, specifically because of concerns for manipulation, is one of the reasons we decided to focus as a company on trade surveillance. It, I think I read every single rejection document. Maybe I'm exaggerating a little bit because they proliferated towards the end. But definitely in those early days, Gemini, etc., like the Winklevoss ETF, I spent a lot of time on them, and I thought actually, while I did think that it should be approved, I also thought the SEC was raising an interesting point. Essentially, when I read the rejection document, then what I read was the SEC is essentially asking, okay, so there's this new kind of asset class and it's decentralized. Let's say that we and our role is to make sure if we create this smaller degree of separation between this new asset class and U.S. securities markets, that we have the ability to know if someone has manipulated that asset and through it manipulated, accredited investors in traditional markets. We regulate 60% of the world's capital. We need to have some security that there's no manipulation happening. Now, how do we do it? So, historically, securities, for example, they're native to one exchange, right? So, for example, an Apple stock is the underlying is traded on Apple. Digital assets are traded everywhere at the same time. Anyone can start a new Bitcoin exchange. Anyone can create a new wallet. Anyone can even create their own new asset. Now, how do we get the confidence that this isn't manipulative, especially when it's so volatile? And we have to remember that some of this conversation was 2018, 2019, 2020, right? Like the markets look different then for digital assets. Now, okay, so even if we take, let's say, 10 exchanges, regulated exchanges on which these assets are traded, then what about all the other places where it might be traded? We have like a unique fundamental infrastructural challenge here. And I think that the SEC actually in the rejection documents, even though I disagreed with them, pointed that out very well. This is the first non-physical asset that is not native to one particular exchange. And what does that mean? Now, the way they address this in traditional finance, and you touched the idea of shared surveillance agreements. So they're essentially an agreement that a lot of different all of the US SRO, self-regulatory organization, designated exchanges are signed on them, and they also have members of the same agreement who come from foreign national exchanges. But essentially the idea is that if there's let's say someone wants to create a derivative of a US stock and a foreign exchange, if the SEC has some sort of concern that there's manipulation between them, then they can then the agreement essentially forces both exchanges to share the data for investigation purposes. So to be clear, by the way, that was very interesting for me when I looked at the intermarket surveillance agreement. The intermarket surveillance agreement was that there isn't actual any surveillance going on. It's more an agreement to share data for if there is an investigation. Um, but what they said essentially when the SEC when they rejected all of this is that we don't understand how you can create an agreement like that for digital assets again because these assets are traded everywhere. It's not a bilateral cross traded assets. Now, ultimately, as we know, the courts sort of forced the SEC to approve the ETF, and you could kind of see that there was, at least to me, it seemed like there was a bit more. There was just not a desire to approve it, because ultimately there was enough data out there on the fact that like there is manipulation, but it's not necessarily like a reason not to approve it before, and the SEC kind of found a way to approve it. But the fundamental infrastructural problem is still there. Um, Digital assets are traded, and now that also we have the Bitcoin futures on CME, etc. Like there's also regulated markets that have been trading these for a while, so there's a bit of a track record. But essentially, if I understand your question, Nate, you're asking how do we need to think about it when we start thinking about all of these other assets that are out there. And I had the pleasure of listening to your conversation with I think it was Matthew Siegel from VanEck a week ago, and it was really interesting to hear how they're thinking about like wrapping more digital assets in this. Look, I think ultimately the answer, I think that we passed like the Rubicon of the SEC approving the first ones, and we're going to see more approved. It can change maybe with different administration, different focuses. Obviously, any instance of blatant market manipulation that impacted crypto markets, whether it's spot or futures, and therefore trickled into traditional finance, is going to make it more difficult to get new ones approved. So the main tip from our side is for the industry is continue raising the standard for integrity. Most regulated exchanges today have strong surveillance programs. In some cases, actually, they're stronger than traditional finance. And again, I cannot stress enough just the fact that like we keep on talking about the issues in crypto, but like JP Morgan was fined $1 billion about 4 years ago for spoofing market manipulation, right? So, but keep on raising the integrity standards. And then there are also other things that we could do and have been working to promote. We specifically, the idea of a shared surveillance or information sharing agreement specifically for digital assets. We launched something called the Crypto Market Integrity Coalition back in 2022. We were honored to co-found it together with Coinbase and Circle and a bunch of other large platforms. It was 17 when we launched. Today, there are 51 of us. And there's a lot of discussion internally. We essentially are all focused, and it's voluntary. No one is paying for it. It's just people who really care about improving market integrity in crypto. And there's intense conversations we've been having about creating a shared surveillance agreement that is fit for purpose, that could preempt maybe concern that we could see in regards to approving other exchange traded products moving forward. So ultimately, the first the first ETFs got approved in part because the standards of integrity have been raised, and we need to continue that motion, especially as we're going to see more and more TradFi involvement and cross-traded assets between TradFi and digital assets, etc. I hope I answered your question. It was a bit of a long-winded one, but you got me excited because I don't get asked about this that often, and I'm also passionate about it.
I absolutely love this. I love getting in the weeds on this topic. I guess what I'll ask you, just to boil this down, and I'm not asking you whether the SEC will ultimately approve some of these additional spot crypto ETFs, but in your opinion, if you look at some of the higher market cap crypto assets and ones that have much higher trading volume, do you think there are currently sufficient surveillance tools in place that a regulator should be able to get comfortable with allowing those into an ETF wrapper?
Well, it depends. I mean, look, again, if you look at Solana, the report we published doesn't look very good. Again, it's not necessarily the Solana token, right? The Solana token is a different story, but there are a lot of market integrity concerns everywhere. I think that being said, it seems that the current administration is leaning more towards, unless there is like an immediate huge concern that's very demonstrable, it's not necessarily the government's job to decide what investors should get access for. And getting access to digital assets through a fully regulated and closely monitored instrument like an ETP in some ways is safer than people having to go and buy them. So I think it's very clear there's demand and interest, and those tools are very effective, relatively safe. And you can see that someone like the folks at Van Eck and the other platform, other ETF issuers are very thoughtful about it. Like they're not some crypto kids. They're a bunch of they're very experienced folks that are trying to think how we can make it safe. So I suspect that we'll see more and more approvals. But this issue of market integrity and market manipulation is going to be continuously raised. That's part of why it's very important for us. We sometimes get flack from the industry for publishing negative numbers like the ones I mentioned on insider trading or Solana. But sunlight is the best disinfectant. And if it so happens that some of these new ETPs get challenged for market manipulation issues, we have a lot of research to show the problems, but also how they are being addressed. And again, all of this should be mentioned in the context of the fact that traditional finance haven't been able to fully resolve market manipulation as well. So it's not necessarily traditional finance and traditional ETFs are perfect and there are no issues and therefore we cannot approve something that is not perfect. It's more of like, how do we continuously educate, continuously show that there's effort, continuously show that there's monitoring and controls, in the case that some of these concerns would come. And I need to, sometimes I feel like I need to remind people also that regulators in some cases are driven by politics and maybe things that don't feel very substance driven to us, but also they're individuals that are entitled with helping protect people's hard-earned money, right? So I just want to say that like these reservations and concerns can be legitimate. So it's more about having the ability to have dialogue with regulators and show them what's being done to address some of these issues.
Such a great point, and I also love your point of TradFi markets and that somehow there's this narrative out there that they're pristine, that none of this happens in TradFi, that this is all crypto-centric, and obviously that's not the case. So I think it's good to dispel those myths.
Yeah, I mean, listen, when FTX happened, and FTX was a tragedy, there's no question about that. It was a tragedy, and I think it really reminded many of us in the industry that we cannot be complacent. But when FTX happened, I would sometimes remind people, listen, Lehman Brothers happened, and it was a fully regulated bank, Signature, Silvergate, etc. Like, unfortunately, collapses, etc., happen in traditional finance, even though it's heavily regulated, heavily monitored. Not to mention things like Madoff or So I'm not saying this to reduce the burden from crypto. Like, I actually think we're the new kid on the block. We have a lot to prove, and we also are already we're so committed to solving these things that I can tell you from my work with compliance and surveillance teams in crypto, in many ways there's already a lot that traditional finance can learn from digital assets about better dealing with scam, fraud, and manipulation, because we have this like urgency of proving ourselves, and also because it's a new market, we had the ability to do things a little differently, like for example, build our trade surveillance solution differently than the way it works in traditional finance. So yes, it's important to remember that traditional finance, unfortunately, it's not pristine. By the way, not even only finance. I mean, I don't need to tell you how much scammers are out there. Like, it's a part of the world. It's currently very inefficiently resolved in traditional finance. Crypto has some increased risks as a new ecosystem that's still less regulated and relies on new technology, and also where there's a lot of buzz. Buzz is a manipulator or scammer's best friend. But there are already things we actually do better, and we are actively seeing how large banks, large financial institutions are interested in seeing how the way we deal with these issues in crypto can help them deal with scams and fraud and manipulation better in non-crypto assets.
I love that. And the bottom line is there are bad actors in every industry, unfortunately. And obviously what you're doing, I love what you said, sunlight is the best disinfectant. That's the case in every industry as well. You're shining a light here. Just a few minutes left. I have to ask you about tokenization, which you've mentioned a couple of times. And I'll tell you, I've had conversations around this topic from multiple angles, but not yet from a surveillance or compliance angle. And I'll tell you, Chen, I'm of the belief that we are heading towards full securities tokenization in the future. It's going to take us a long time to get there, right? But I think in the meantime, we're going to be living in sort of this hybrid landscape where traditional securities may be trading both on and off chain. And
Yes,
so
yes.
I'd love to hear how you think about that, and how your firm might evolve as tokenization gains momentum.
I think you hit the nail on the head. Um, there's so much excitement about tokenization. I think it's important to remember that there was a lot of excitement about it 6 years ago. Like I remember going to tokenized asset events in 2018, 2019. Everyone were convinced in a month from now we're going to have secondary markets. But the work has continued, the building has continued, and we're getting closer to it. I'm a member of the CFTC's Global Markets Advisory Committee, for example. We recommended, and ultimately the CFTC's commission approved using DLT as a system of record. That's an important step towards allowing commodities platforms like you to essentially use DLT or blockchain as the way for tokenization, and we see it everywhere. From a risk monitoring perspective, at the end of the day, we're going to have a world where heavily regulated assets like securities are traded, have a life cycle that begins off chain, moves on chain, and then potentially back off chain. Uh, they are going to operate in permissionless. Larry Fink at BlackRock said that originally they thought permission blockchains are going to be the killer use case, but they now believe it's going to be permissionless because that's a big part of the efficiency. You're going to have these heavily regulated assets that live both on and off chain, constantly moving back and forth, and are also in permissionless ecosystems, like Ethereum, where you also have a lot of scams and frauds that are unique to crypto, rug pulls, etc. Um, they can suddenly be essentially like an exit route, for example, like a security can become an exit route for a hard-coded rug pull scam, as an example. Like there's a lot of new scenarios, and the bottom line is that it changes and in some ways increases significantly the risk surface that you have to monitor for and the way in which you have to do it, which is, we believe monitoring cross on and off chain, having, utilizing more data signals in order to understand if there are, other places where it's going. And of course, last but absolutely not least, increasingly introducing AI and AI agents that can utilize all of this transparency so that we don't get, utilize all of this transparency to actually more effectively monitor rather than just get buried under, massive amounts of data. So, we work with stablecoin issuers on monitoring the secondary ecosystem of their stablecoins, and we are increasingly in conversation with tokenized asset issuers, and of course the platform where they will be traded, to put in place, effective tools that can monitor. Again, without creating more burden, but can monitor in this increased risk surface environment.
Yeah, the way I think about this is that your surveillance tools, you have to be able to bridge both environments. And that's
Exactly.
a really complex task. Now, lucky for you, you're involved in both TradFi and crypto markets, so you sit at a perfect spot here. But I can see how that's a really challenging, problem to solve.
I mean, yeah, it's challenging, but it's also exciting again because it hasn't been properly solved in traditional markets, right? So we actually have an opportunity to do this better. Yeah, I mean, we strongly believe that we're seeing both spaces move one towards the other. You can already see it on the ground. For example, by the way, the other side of things, we see more and more crypto platforms that are interested in offering securities and derivatives. And part of the reason is because they also see the opportunity in tokenization. So they want to be able to offer those as tokenized assets. So on the one hand, you have crypto moving more towards traditional finance. On the other hand, you have more and more traditional financial institutions that are looking at offering digital assets. And a market structure bill in Washington is supposed to create clarity around how, as FINRA regulated broker can now offer Bitcoin and Ethereum, right? So you're seeing this motion from both sides, and tokenization is sort of the highway where I believe they'll meet and start accelerating together.
Well, Chen, absolutely excellent insight this week. If you can't tell, I find this topic to be extremely interesting, and certainly Solidus is a very interesting firm. Thank you so much for taking the time and joining me.
No, of course, absolutely. Thank you for the listening. I told you before that I can get a bit lengthy because I get excited and I can talk about this for hours. But I appreciate the opportunity and your very sharp questions. Your passion for ETFs I hope you feel has met its match on the surveillance side of things. And yeah, I hope to be back. Thank you so much.
Well, thank you. That was Chen Arad, co-founder of Solidus Labs. Thank you for listening to or watching this episode of Crypto Prime. As always, you can stay up to date on all of my latest guests by visiting CryptoPrimePodcast.com. See you again next week.
Crypto Prime is hosted by Nate Geraci, president of OTR Media LLC. Nate is also president of the investment advisory firm The ETF Store. While OTR Media LLC and the ETF Store are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by the ETF Store. This program is for informational purposes only and does not constitute investment advice. Investing in crypto assets involves substantial risk, including the potential loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Visit CryptoPrimePodcast.com for more information.